Happy June. Thanks to all of you who are joining us again live for this month's town hall. It's great to be back together with all of you again, and we've got a number of key organizational updates this morning. So we've got HR updates delivered by Nicole and Dustin, followed by our quarterly financial update, and then the latest on what's going on in redevelopment. So as always, the meeting is being recorded, and we will follow up shortly with a link to that recording should you miss any part of this morning. Welcome, Dustin and Nicole, and with that, I will turn it over to you both.
All right, thank you, Anna. Good morning, everyone. I'm excited to be here this morning to share with you our Values in Action winner. And so for this past time, I want to congratulate Martin Esperacueta, our Senior Project Manager in Pflugerville. And I want to share a little bit about what Martin's peers had to say about him and his nomination. It says, in working closely with Martin and his team in Pflugerville, his focus on teamwork has created a culture in our team that allows us to work together seamlessly. The culture that Martin has helped lead and facilitate has allowed for open communication, ensuring that we are able to provide clear direction to our subcontractors, thereby eliminating delays. Also, Martin sets himself apart by his leadership ability by providing clear direction, upholding a high level of integrity amongst the team and subcontractors alike, and holding team members and subcontractors accountable. Finally, his constant uplifting attitude is so encouraging daily and motivates myself and other team members to perform at a high level. So that is awesome. Thank you, Martin. This is very well deserved. And I also want to take a moment and recognize all the people who were nominated. Quite a long list here of folks. So congratulate those folks as well and keep those nominations coming in. And now I'm going to turn it over to Dustin, who's going to talk about the people updates.
Thanks, Nicole, and good morning, everyone. And again, congratulations, Martin. That's great, very well deserved, and keep that momentum going. So now we'd like to talk about our team member announcements for the month of May. And to kick that off, we are going to start by welcoming our new hires. So as you can see, we've got quite a few new faces that have joined us to the team here, including Jennifer and Ron on our accounting, finance, and tax teams. Greg has recently joined our IT group, Amanda at CHR, Sarah, Lexi, Cameron, and Sean. We all welcome you to the hospitality team. In addition to that, we have Nell, who joins us at Armada, and Alex, Tripp, Maggie, and Richie have all joined us as interns in the month of May. So we welcome all of you to the team. We're excited to have all of you, and for those of you that see these individuals around, please make sure to introduce yourselves, say hi, give them a warm Elsie welcome, and keep building those connections. So next, we would like to acknowledge and congratulate those individuals that were promoted in the month of May. I think we talk a lot about how we develop our business and how we continue to grow. I think it's also important to talk about individuals, how we grow those as well. So we're certainly excited to acknowledge these promotions. As you can see, Austin Page, Bridget Celio, Ernest Ellis, Mackenzie Davis, and Zach Ashley have all taken on new leadership roles within the hospitality team, so that's great to see. Hannah Brachet and Sam Lane have also taken on new roles in the home team. We have Alfie Ciccone and Angel McIntyre that have stepped up at NEP. And also Patrick, for those of you like myself that may know him as Packy Dougherty, he was promoted to the Director of Amenities in our development group as well. So congratulations, Packy. And in addition to that, we have Heather Sells and Mary King from our accounting team down at our Nashville home office that have also stepped into new roles. So congratulations to both of you ladies and everyone as well. So very well deserved, and we look forward to all the great things that you'll be accomplishing. So now we'd like to move on and recognize our work anniversaries for the month of May. So as you can see, we are kicking it off by talking about our 1-year anniversaries and the individuals here. I think this is always a big milestone as you kick off and get over that first year. So it's exciting to see all these names on the list here. So congratulations to all of you on completing your 1 year. That's a big mark. Moving on, we'd also like to acknowledge Justin Balo for his 2nd year anniversary, and Richard, Courtney, and Scott Gonzalez for completing their 3-year anniversaries. So way to go, gentlemen. Catherine Matrangela and Liz Reed are completing 4 years, so congratulations to both of you. And certainly a big mark at year 5, Caleb Markwood and Key Real Trashkov. So congratulations to Caleb and Key. Great job on completing 5 years. And then rounding out our anniversaries, we have Ashley Reinhart, who just completed 6 years. So congratulations, Ashley. And Vera Jordan with our NEP group, and James Schaumluffel have completed 8 years. So congratulations to both of you, huge milestones, and it's great to see that tenure. So on behalf of LC, we certainly appreciate all of your hard work and everything that all of you have done. I know we certainly couldn't be here without all of you, so thank you. And we look forward to celebrating many more anniversaries as we continue to grow and develop. So I think that wraps up our people portion of today's meeting. So now I'm going to kick it over to Anna to take up.
Thanks, Dustin. Thank you, Nicole. Congratulations, Martin. So well deserved, and thanks for all that you are doing. And again, big congratulations to all of our big milestone tenures. It's so great to see so much experience across the organization. I am excited to welcome our finance team to the town hall as our next list of presenters. We have our quarterly financial update. We've got Mike Aamodt, Matt Nelson, and Buffy Wilson, who will be joining us to talk a little bit more about what's going on financially in BRG, home and hospitality, and construction and development. Oh, give us just a moment.
Good morning, everybody, and thank you, Anna, for having us this morning and allowing us to talk through our financial performance for the first 4 months of the year. And also thank you to Matt and Buffy for joining me and allowing you guys not to have to listen to me for 30 minutes to talk about this. So, my name is Mike Aamodt. I am the CFO of the company. This is all the way to the left, Matt Nelson, who runs our finance and accounting team for home and hospitality, and Buffy, who joined us from Nashville today, so thank you. Well, flew all the way here from Nashville, so thank you for that. And sorry I'm out of breath. I ran up to make sure Buffy knew where to go, so to cut the tension right off the bat. So, but yeah, thank you to everybody. Again, thank you. So today we're going to talk about our financial performance a little bit and really hopefully identify why it's important to the company if it isn't obvious. But overall, the first start of the first 4 months of the year have been very positive, and we have seen great growth, not just from the construction standpoint, but also on the apartment operations. And so we're excited with where the company is at from a performance perspective and also from an operating perspective. And so as I sit here and say, why is it important for us to recognize revenue, us to make NOI? All right, so here we go. So we're going to talk a little bit about our revenue and net operating income today for all of our businesses. But first and foremost, why it's important, right? We have to make money to pay our people, pay our vendors. All this NOI that you see on the table then further goes to pay our debt service, pay our make investments for our capital expenditures, And then from there, we do have to return capital to our partners, so they want to come back, invest in us so that we can raise the money to grow the company. And so obviously our ability to operate a portfolio, earn revenue, increase our revenue stream, ability to pay off our debt holders, make money for our investors, just enables our ability to grow. And so that's why we're going to talk a little bit about it today. And as I think through really the vertical integration, Buffy is going to talk a lot about development and construction services, what she's seen in that industry, the risks to that industry, the opportunities that we have in our existing company. And then we'll go Matt first, Buffy second, but then Matt's going to come in and talk about what the rental rates are doing, what our occupancy is doing, how the pricing adjustments are impacting the GOAT and all of the side hospitality businesses. And so as I start off in thinking about the company, we have the development team that's responsible for finding sites that meet our brand promise and our market demographic. And then our construction team is responsible for making sure that we can build it for what we estimate it for and on time, on budget, at the Class A quality that we expect. From there, it all gets handed over to our home and hospitality team, and they take the reins in making sure that the project gets leased up, that we are opening our GOATs on time, our service offerings on time, and offering really the hospitality and brand promise that our tenants and our demographic are promised for. So with that said, at the bottom, you have Builders Resource Group is really our corporate entity. That's where our corporate team sits. It's our shared service functions of our legal team, HR, IT, marketing, and finance and accounting. And so with that said, kick that off. The company's performance to date, as you look at 1LC, you can see 121% revenue growth over the prior year. It's fantastic. It's demonstrating that we're really pushing to our Vision 2025 and getting to the unit count that we desire and have challenged ourselves to. So the bigger the revenue number in construction, the more units that are being built and the more units that are being delivered over to property management and the LRP team. From a development standpoint, while it is extremely choppy, I think what I'll say in development is probably on the next slide, the team is actively finding really great sites, putting them in contract, and really allowing the catalyst to grow into 2022, 23, and 24. And so while you don't see these big numbers on lifestyle development, from a financial standpoint, the underlying work and our growth kind of starts with them and the fees that they generate and the progress that they make. As we get into home and hospitality, we're 18% growth over the prior year. We've seen really nice rent growth. The GOAT has done a tremendous job in dealing with a very challenging environment in terms of coming out of COVID, in terms of really a difficult supply chain, which Matt can talk a little bit about, and then also just passing through a significant amount of revenue increases and dealing in a really challenging labor environment. And so all that with the delivery of Sobro and the delivery of Briar Creek Phase 1 in the second half of the year, you're seeing really nice 18% revenue growth there. From a corporate standpoint, you see a big negative here. A lot of this is transaction income and timing. I think what's most important is that while we're behind on revenue, we're managing our expenses really well and keeping kind of that expense load weighted appropriately with where the revenue and net operating income is coming from. So overall, we grew at 38% from a revenue standpoint. Even more impressive, a 60% growth on NOI, which is just tremendous in terms of our ability to operate a business and tell us what does it mean and demonstrate for our growth. And then obviously 38% revenue growth year over year, that's really challenging to do, especially when the construction company is 10 million of that. It's just really nice to see in the annuity business too, the revenue growth that we're seeing. So next slide. I'm gonna skip the first 3 bullets there because I talked a little bit about it and I don't want to steal Matt's thunder. But some of the highlights through the first 4 months of the year, we have River South Matin is in lease up. These numbers change daily, but from what I feel confident saying that it's over 50% occupied and over 70% leased for the most part, which is ahead of schedule, which is great. Line Street in Pflugerville construction is moving very, very fast and ahead of plan, which is awesome. And then LC Briar Creek 2 land development has started. And I was actually thinking through this morning, I can't recall another time where we had 3 very, very large projects going vertical all at the same time, which is going to be exciting to see and really a testament to the work that the Nashville office has done from a development and construction standpoint and getting those projects out of the ground. From a development perspective, we acquired one piece of ground in the quarter, down our second project in Texas, and then even more exciting is we put four additional pieces of ground in contract in Charleston, Nashville, and Austin. And we are actively targeting a new market, which I won't steal thunder from because we don't have that locked up yet. But I think the exciting point in the development is we are getting a very active pipeline to essentially hand over to Buffy and Tom Fichter to start to grow and start to build. So excited about what the development team is doing right now. Rob is gonna cover, I didn't realize he's on the agenda for this afternoon, but for this morning, he's gonna cover redevelopment a little later. I don't wanna steal any of that thunder. But then I think the second to last bullet point, we executed a number of transactions late in the year, last year. We sold out of the Louisville portfolio. We did a lot of debt refinancings on Briar Creek Phase 1, on Sobro, even on the River South project, and that allowed us to, in a rising interest rate environment, we paid off a significant amount of our holding company debt, which has allowed our borrowing base to go down, save all of that cash that we generate from NOI. It's got to be used to go fund debt, interest, principal payments, CapEx, and having that debt repayment has been a nice increase to our ability to generate cash and grow the company. So last one is menu pricing adjustments for the GOAT. I know that's been a big topic that's been discussed from the operating perspective, and Matt will get into that a little bit later, but thank you, and thank you for dealing with my winded rush down here. Matt, looks like we're kicking it off to you to talk more about home and hospitality.
Thanks. Mike did a nice job kind of teeing up the overall performance for the whole portfolio and some of the massive growth that we've really seen, which is including some of our unstable or newly leased up projects. I'm going to focus more in on just our same store, which excludes those. It excludes Briar Creek, Sobro, River South, and just focuses on the assets that have been really stabilized for the last 2 years so that we can kind of see how we've performed on a same store basis. And really, I just have 3 charts here that I think really do a good job of illustrating what we've seen, not just in the first quarter of this year, but really over the course of the pandemic. It's been remarkable to see. This first chart is it tracks our net rental revenue, which is basically saying if we were 100% occupied, every single unit was leased. This is the revenue line. That yellow line is what you would see in your monthly revenue across our same store. And then that's over a trailing 12-month basis. The orange line below that actually tracks the 12 months prior. So if you were to stack the orange line in front of the yellow line, you'd get 2 full years of rent growth. And it's really remarkable to see, starting around May of last year, how that really just took off. And through 2020, I think we were a little cautious. We were conservative. That was when the pandemic was new. It was uncertain, focused on collecting the rents and keeping the units occupied. So you see that line is pretty flat. Typically, I think you'd see a little more growth than that, but needless to say, once you hit May of 2021 is really when we started to see things take off. The other element on this chart is the bars, the blue, dark blue and the light blue, which represent our lease trade out, which is really our leading KPIs that we use to track and see how we're going to be doing in the future in rental growth. So those have trended, for replacement leases, those have trended anywhere between 15 and 20% over the last year. Renewal lags behind that. That's intentional. We control renewal increases because we don't want to create too much vacancy by jacking up the rent. If you just trend them, or if you just hold them at true replacement leases, you might have everybody say, okay, I'm going to move out, and then you have more vacancy than you wanted. So it's very much intentional to see how there's a big gap in between those, but one thing you do see is the renewal rates are increasing month over month pretty consistently. And if we look forward to May 2022, leases signed in May 2022, we've actually seen north of 20% replacement increases and north of 10% on renewal increases, which are both, I think, high watermarks. One last comment on this is that our portfolio on average has about a 15 to a 16 month length of lease on average. So, we're a year out at this point from when we first started seeing these increases. to get to that 15, 16-month mark, to turn those first leases that saw these increases. We've got another 3 or 4 months before I would think that we would really start to see it peak.
Yep.
And peaking means that the market has cooled off, which is definitely not even certain, right? So
Yep.
I think the increase to rent at the top line is something that's going to be here with us for a while. Things are still trending in a very positive direction, no sign of cooling off. The next chart is so as I said, that rental revenue is assuming 100% occupancy. So the other side of our revenue is occupancy itself, which coincidentally around the same time kind of took off along with the rental rates. So the chart on the right side here kind of tracks our quarterly, this is our seasonality curve. It's typically what it would look like if you looked at it just quarter over quarter. But what's really different about this is that it's just elevated. It's way above what we would traditionally see. On average, we would traditionally see about 95% occupancy. And in the summer months, you'd be above that, and then in the winter months, you'd be slightly below that, but it would average out. So what's not on here is Q4 of 2020, and I looked it up. We were at about 93%, which is pretty typical for where we were at before. But then starting in Q1 of 21, you saw it jump. That was above average at that point, and then it just took off from there. And you see it dip in Q4 of 2021, but it's still well above. It's at 96.3. And then if you look at our year over year, Q1 22 to 21, you're about 70 basis points higher than you were a year ago. So that really tells the other side of the story. If you were to look at that, the rental rate growth, it accounted for approximately 8.5% year over year rent increases. But we're sitting north of 10% on a same-store basis, so the other piece of that is our occupancy. The chart on the left here is really kind of tracking your quarter-over-quarter growth rates of your total revenue, which is the multiple of those two things in blue, and then our net operating income. So a couple things to call out here. If you just focus on the 2021 Q1 through Q4, all positive, and it's funny, you see any one of these quarters could have been an entire year in the past. You stack them all together and you've got 10% rent growth. What's really, I think, remarkable for me is if you look at the gray line and the NOI growth, it's showing that huge growth rates in NOI, and that means that we've done a really nice job of controlling our expenses. So these revenue growths through 2021 and into the beginning part of this year have really dropped through. You do see one negative here in Q1 2022. That's really just a one-time impact, though, from snow removal costs. We've already seen that reverse, and we're back in the positive trajectory going forward.
Yeah, I guess I think that's the only thing. The thing I'd add is over the last 18 months, I know we've studied a lot of institutional REITs, and we've studied a lot of kind of what the best-in-class market looks like for occupancy, and then as you drill down one level below that, I mean, we've focused our efforts significantly on improving our average days vacant and expanding our average lease to that. I think we're 14 months, 18 months ago, up to 16 months today, and so I think with those improvements, what we saw is we saw millions of apartment units that were managed by a few Class A multifamily REITs that were operating continuously at 96%, and we were around 93, 94, and we said, well, what are they doing differently, or what are they doing that we're not thinking of? And we challenged Chad and Sam at the time, and Marcy and the team members to say, let's get this up to 96%. We've had things that have helped the multifamily industry in general behind that, but there's been a substantial amount of things that are in our control that we've improved upon in the last 18 months.
Absolutely.
And both on our investments in technology and people on the rent side, but also on the occupancy side. Now, it's harder to grow revenue when you're already at 97% occupancy, and so it's harder to get better than that, just with where we're at. And so I think that's a testament to the team in looking at the institutional benchmarks that we've challenged the teams with and their delivery on that. So I would say that the industry in general is seeing huge rental increases all over the place, but at the same time we're keeping up with the top operators, which is a testament to Matt, your team, and the operators that you partner with. So I wanted to add that in.
Yeah, and for me, one final comment is, we've done really well on the operating expenses, controlling things. and keeping them basically level, but that's certainly not something to take for granted. As we move forward with inflation, we're seeing pressure in utility costs. We'll see it in appliances and materials like paint and things like that. So that's going to be something that the team's going to have to continue to manage and really lean on our best-in-class program to continue.
Buffy can probably hit it high on inflation. So
Yeah, we'll
she
get
does.
more of that here in a minute. So my last chart is focusing on the goat. And so the goat so far has been pretty much flat to budget on a same-store basis for total revenue, which has been great, all things considered. So this chart, I feel like, really tells a good story of kind of what we're dealing with the goat. So this is it's tracking our margin, which is how we like to really evaluate everything in the goat. It's through the lens of margins and how are we doing, because it's transaction-based. And every penny counts, basically. So these are some of the controllables and uncontrollables that we're kind of tracking to that are represented in these bar charts that go up and down, and they're having an impact on the margin. And then the line that you see, the solid line that goes through this, is the actual margin itself. So the negative impacts are the ones that are orange and red, things like commodity increases. So we're seeing about a 30% year-over-year increase to our cost of our commodities, and then we have gap, which is basically just food waste and operational things that the team can control. That's something that we continuously track to and try to execute on. And then on the positive side, we passed through a price increase in September of last year. It's kind of hard to tell on this chart because it's all the same shade of green almost, but that's one of the lighter shades of green that you can see that's hitting in January through March. And then we more recently just passed through another price increase on both liquor and food in the middle of May. And so far, in just a half a month, that trend is going really well. And if we trend that out, and this is forward-looking, so there are definitely risks to this, but if we trend out this most recent price increase, we are very optimistic that we'll get back above that 75% watermark on our margins. With that said, this is still the restaurant industry. There's still a lot of uncertainty with labor costs, with commodities, with inflation, and so we monitor it closely and track it every day.
So Bill just signed up for 75%, so thanks.
So that concludes my remarks on home and hospitality.
Great.
All right.
Thanks, Buffy.
All right, thank you, Matt, for segueing into development and construction, which is one of the driving forces of bringing new revenue and profits to the company by way of bringing new projects to market. I don't have any fancy graphs or charts to cover, but what I did want to spend some time on is talking about what development and construction are working on collectively to bring about new revenue and profits for the company. And hopefully I'll get there with the fancy charts and graphs.
Matt has the benefit of a lot of these being done before. So,
Yeah.
Don't take it too hard.
So from a development front, as Mike mentioned, we acquired new land in, actually that's Q1 of 2022. The slide says Q2, but it's Q1, in our Austin market with Leander. And we have 6 new properties coming under contract in 2022, 4 of which are already there. We have Hyatt Meadows in our Columbus market, Holly Springs in the Raleigh market, Ingleside in our Charleston market, Phase 3 of our Pflugerville project in the Austin market, Phase 3 of our Sobo project in Nashville, along with Central Pike, which is also in Nashville. From a process standpoint, many of you have heard about this pencil to perm process through these town hall settings. And what that is a coordinated effort with finance, capital markets, legal, construction, development, and our home and hospitality groups, whereby we are working together with the transparency of the project challenges and timing on the project delivery. The intent is to accelerate the due diligence and the project development to construction. And this includes schedules for each project tracking delivery dates, such as land acquisition, civil and architectural plans, the cost estimates, and the market studies that go into the investment theses. We have regular, consistent communication through monthly meetings and ad hoc meetings if we need them. And then finally, we have a documented approval process or next steps to move forward so that all stakeholders have buy-in with the process and throughout the process.
Yeah, I think, Buffy, the key here is these are 6 new projects that we have in contract, and not to mention there's 4 or 5 other projects that are on the list that yet to get into active development or active construction for that matter. And as you look, I made a comment at the top around, I don't know that we've had as many big, large-scale projects going vertical all at once, and then you sit here and you throw 10 additional projects on with the 6 new ones and the 4 that are currently not yet to get under construction where we own the land, and you see the amount of growth that the company is experiencing, and the pen to perm is really the operating model that allows us to get the resource allocation that's needed, and then also just the de-risking of the organization for the amount of risk that we are going to take in having 10 projects come out of the ground in the next 24 months. And so I think while this is an LCS and a development financial update overview, the critical pieces to achieving those are within the collaboration of pen to perm and making sure that the organization is ready for 10 projects in addition to the big 3 ones that we already have. 10 additional projects coming out of the ground in the next 24 months. And so I just wanted to segue that for you a little bit.
Yeah, well, in addition to that, with all of those challenges coming into play, with the amount of projects we have coming on board, we're also working to develop the teams within the construction and the development units.
Yeah.
Because there's a lot of work to be done, and we don't have everybody we need, so we need to develop those resources internally or acquire them from outside.
Yep.
So some other value-added processes that are currently in the works is where development is focused on a disciplined consistency on site and design plans across the markets, working with preferred vendors, consultants, and providers. And pre-construction specifically is focused on a standardized material cost price book with options for each market, establishing national purchasing and sub-market relationships, particularly in the new markets we are in, such as Charleston and Austin. And what we hope the anticipated results from all of this, as Mike alluded to, with all of these efforts, are really to accelerate the profit recognition and cash flow for development and pre-construction services, which leads to a quicker turnaround on construction for revenue growth and profit growth. And finally, a quicker turnaround to the leasing market for Matt's team earning tenant and restaurant revenue. Overall, development plans to bring 7 projects to construction in the next 24 months with an estimated 3,000 units.
It'll be 10.
10? Okay.
No, I'm kidding.
Well, I have 7 tracking on my spreadsheet right now. From the construction front, we have 3 active projects under construction. The first, Line Street, Phase 1, which is in our Charleston market, and we have a picture slide and a couple of slides to show you exactly where this project is. It's very exciting to see. This is 280 urban units plus amenities. The construction on the main building is progressing with up to the 3rd floor with major trades. And then we have the train and the Enclave building continuing, which is the historical aspect of the project. For the train station, 80% complete on the structural masonry. And for the Enclave, we are over 90% complete on the structural facade and the interior framing. Through April, we are 30% complete on the overall project, and we expect to be 60% complete through the end of the year. Our first units are planned to turn in Q3 of 2023, and a completion expected in Q1 of 2024. Then in our Austin market, we have Phase 1 of Pflugerville, which is a 400 suburban unit with amenities. The land development is completed on 3 of the pods, and the vertical construction started in May on each pod, which includes the amenities and the goat. So those will be first deliveries on the property. 14% is complete through April, when we expect to be 45% complete through the end of the year. And we plan to turn the first units in Q1 of 2023 with a completion of Q3 2023. And then finally, Briar Creek in our Raleigh market is 300 suburban units. The land development is underway with Section 1, and there was a slow start with the delayed GMP and the financing and getting the Section 2 plans together. But the good news, while the team waited, the project team worked on achieving 95% buyout on Section 1, which is a great feat for controlling cost. We are 5% complete through April, which includes land development that occurred on Phase 1, and through the end of the year, we expect to be 25% complete. And as we talk about bringing new projects to market, we are mindful of the economic challenges and the risks that development and construction are facing. Demand is exceeding supply, whereby land is almost always competitively bid, resulting in high prices and reduced due diligence periods for zoning and entitlements. High demand for services, resulting in longer wait times for delivery of services such as site plans, design plans, and legal services to assist with zoning and entitlements. On the new market barriers, strong demand for real estate investments in our newer markets has increased competition for development, giving greater advantage to developers with an already established presence in our markets like Austin, Charleston, and Raleigh. And further, the growth has empowered municipalities to have land use and zoning expectations that are inconsistent with market conditions. The good news, as Matt displayed and Mike talked about, is that we have a strong forecasted demand in the markets we're in, with projected rent growth and occupancy rates. So we're looking forward to bringing those to market so we can continue to grow as a company and meet our vision. From the construction front, construction input prices from a national perspective have increased 24% over the 12 months across all markets. Specific to residential and commercial construction spending, spending has increased 18% just in 2022. It continues to be a supplier's market with the high demand for commodities, coupled with supply chain constraints and reduced labor force. There has been recent stabilization in the lumber market, but we continue to see volatility in steel and copper. And as you've seen at the gas pump, energy and diesel prices are rising, exacerbating transportation and raw material cost. Since the pandemic started, we have seen supply chain disruption with global manufacturing shortages, import challenges with coastal ports affecting prices and demand. But we are starting to see an uptick on the manufacturing, just looking through the economic factors, that's starting to come up. So we expect to see some relief by the end of the year, loosening that up. Skilled labor force and manpower has always been a factor in construction. The pandemic, again, has exacerbated the problem because real estate and construction really stayed strong throughout the pandemic, but with a decreased workforce. As we work as a company through these economic challenges, overall development and construction business units are poised to see high growth over the next 24 months, working together to improve our internal processes as well as our external relationships. And hopefully we'll get to those 10 projects.
Thank you. Thank you, Matt. Thank you, Buffy. I think to just belabor the point a bit on construction, I know just the last 18 months has been quite a challenge, specifically on our Line Street project. And the team is really fought through dealing with significant headwinds in terms of our subcontractors essentially having pretty much more authority and more ability to pass on pricing risk than we've ever seen before. But then more importantly on Pflugerville and Briar Creek 2, the experience that Tom has brought in his home building business and the team that he's put together, we've done some creative things in terms of locking in pricing on lumber. I know Tom bought half the Pflugerville project off the rail car to control the prices so that we didn't have lumber suppliers passing through. We have seen a very abnormal having to put down 50% deposit on kitchen equipment. I mean, there's just been quite a bit of items that have changed the way that we've had to operate and be nimble in terms of our ability to really be resilient in this market that we're seeing. And we saw it on the home and hospitality side coming out of COVID, and we're now seeing it on the construction side with the experienced team that we brought. So Line Street picture here is just to put a little bit of eyes to the numbers, but as you can see on the left, you've got just the overall site from the crane that's coming down there on the main building with the enclave off to the left and the train station without a roof on it in the back, and then on the right you're seeing the parking deck go up and the front facade from Meeting Street. And so it's exciting to see for those of you that have been here since 2015 when you started hearing about Line Street lane assemblage. We were hoping that this was our progress back in 2020, 2021, but this project really got hit in the most challenging of times in terms of building permits ready to be gotten in early 2020. This thing just got hit with the COVID pandemic worse than any of our other projects, I would say, from a timing perspective. So with that, I think we're wrapped up on our financial update. Thank you. Sorry again for running in here a little bit behind schedule. I know is probably upset with me, but that concludes our remarks from the finance team, and I think we're excited for the rest of the year and the challenges that we've got to overcome. And 75% margin.
Yeah.
Thank you.
Right.
Thanks, Mike, Buffy, and Matt. We appreciate you spending your time with us this morning. Thank you for being flexible with the schedule, as sometimes we run a little bit ahead of the agenda. Mike, thanks for delivering your update winded, but still making it down here. Now we are going to transition to Rob as he shares a little bit more about everything that's underway with redevelopment and what he and his team have been working on and the progress that they've made and some plans for what's ahead. So Rob, I'll turn it over to you.
All right, thank you, Anna. As Anna said, my name is Rob Zelina. I am very excited to be here to give an update on redevelopment. We're going to talk about really a summary of what we do, the processes that we have in place, the team behind the whole redevelopment effort. Then we'll talk a little bit about the true scope and scale of what we're getting after. So if we can go to the first slide.
Rob, you've got the clicker.
Oh, I have the clicker?
I can.
How do I click this thing? There we go.
There you go.
I should have had this on all the time, all right? Our redevelopment plan, sorry about that. This is really a recap. I think maybe I've presented this before or in different forums, but as we think about redeveloping our existing portfolio, we look at it through what we call our 5 pillars of redevelopment. That is brand management, which is really the expert operation of our communities aligned with our full amenity package. Obviously, in redevelopment, we get after the interior and the exterior renovations. Our amenity redevelopment is really, over the years, as we built communities, we have amenities in various forms, sizes, and what we really want to do is bring the full amenity package to all of our communities and set them up for the next 20 or 30 years of operation. Unit repositioning, that is really a heavy-handed type of renovation. We saw that a lot with LC St. Matt's. Not so much in our existing portfolio, but an example, we do rip out some cabinets in our Stansbury flats. And then build new units. So within our existing portfolio, we've identified the ability to add almost 170 new units to our communities, which is great when you think about we already own the land development is done, so we can build these units at a very affordable price. The other piece to the redevelopment plan is this holistic approach to amenity redevelopment. Again, we want a full aspect of our amenities, which includes co-working, morning ritual, fitness, wellness, pool and patio. And what we're really looking at with our operators is to figure out what we want to be with each one of these aspects of our amenity and how we would set that up for growth for the next 20 or 30 years. Over to the right of the slide, you can see we spend about $3 to $5 million on our amenity, and then down in the interiors, we spend roughly $10,000 to $12,000 per unit. The next slide is process, but before we get into that, I thought I'd talk a little bit about the team behind this. Eric Moeller is our Director of Redevelopment and is largely responsible for the execution of each redevelopment plan at each community. Tom Doherty, better known as Packy, is the Director of Amenities. So he works very closely with Eric to make sure that the amenity redevelopment is done to brand standards in line with our operators. Marcy Grimm and the district managers and the community managers are also largely involved with the coordinating and the scope of what we do. Ted Vinalek, from an asset management perspective, is involved. And what Ted does is, he really is looking at the financial returns on what we have. So if you go down through the process slides, you've got project identification. That's really asset management, sitting down and saying, okay, what are we going to do and where are we going to do it and how do we get started? And it really starts with a collaboration with home and hospitality, and it's a walk of the site. And that is where the community managers can come out and say exactly what they think is needed at the sites. We walk the full amenity, and through that collaboration, we come up with an investment thesis or a business plan for each community. That investment thesis has hit proper return thresholds. It is sent in to grow the business for approval, and once that is approved, the capital is allocated and the project commences. This slide is a little busy, but it's a kind of a schedule of what we have here. When we started looking at redevelopment, we had no idea how large it was going to grow, but we're touching just about every project but for Sobro and for Briar Creek Phase 1. So if you look down the list here to your left, Sunbury, Gahanna, Villages, and Dublin are all underway. Those are active redevelopments going on, and we'll talk about that in the following slides. The ones that are coming later this year and in the next are Germantown, Mount Juliet, Exchange, Murfreesboro, Hilliard, and Farms. So again, we are touching just about everything. If you make your way to the middle of the slide, you can see we will spend over the next 3 years over $100 million redeveloping our portfolio. The incremental NOI growth of over $10 million, that is in excess of, to give it some context, of what Gahanna does, a 904-unit project does today in NOI. The value creation at $220 million is slightly more valuable than Gahanna is. So this is like finding an entire Gahanna, a 904-unit community in our existing portfolio. So what we do is we will start in the interiors today. A lot of the amenity work does take some architectural design work, so they tend to lag a little bit. We will start Dublin and Germantown's amenities later this week with the balance of our communities starting next year. We want to be cognizant of our operators. We don't want to disrupt the pool operations or the goat operations, so we didn't want to take all of the amenities offline at once. So we will layer those starts in to make sure that we're not too disruptive with the operators. Progress to date, I think the important thing is here, it is working. Redevelopment has had its starts and stops over the year, but I'm really proud of the coordination and the progress the teams have made. If you look at the chart here, you can see we've got 4 active redevelopments going. Gahanna has 186 units that was completed as of the end of April. You can see that throughout we are maintaining occupancy. Downtime to renovate a unit is about 3 weeks, so about 2 weeks longer than a typical unit turn, but not too disruptive. You can see the rent premiums, so that's what we're getting, rent bumps above today's market rents on an unrenovated unit. And if you think about a $10,000 to $12,000 investment in that renovation, these are very nice returns for the efforts, for the money that we're spending. Again, it's coordination with leasing. They're making sure that the units are coming offline at the right time. They're pre-leasing to minimize down days, and they're maintaining strong occupancy. Good coordination with our maintenance staff as well, driving the demo work on this. Again, a very collaborative effort, and we plan to start the balance of our interior renovations, the rest of our portfolio later this year. Here is a picture of the Gahanna amenity. These are renderings and some actual demos. So the Gahanna amenity was taken offline in January of this year. It will be back online, go open and operate, and we hope in August or September. The bottom right picture is the tiki bar in between the two pools, and we hope to have that fully open and operating at the end of this month. So Gahanna is progressing on schedule, and it looks to be open fully by the end of this summer. This is a look at some of the interiors that we do. So if you can see the before and after pictures, everything but that dog that you see in the middle is included with this. But we'll do stainless steel appliances, quartz, LVP flooring, backsplashes, cabinet door front replacements, and updated fixtures. The goal here is really to take our units to a Class A standard and compete with the best in the market today. This here is a look at Sunbury. Again, very, very similar scope of interior renovation. This slide is actually pretty exciting. This is our Dublin amenity. So for those that are familiar with the Dublin amenity, if you're looking at it from the road, it looks like the back of the building the building is turned back away from you. It's not very inviting. If you're looking at it from the pool, again, it looks at the back of a building, not very inviting. We want our amenities to have a presence, a true retail, commercial presence about them. So this first look is an update to what the amenity building will look like from the pool. So the GOAT will have a dedicated restaurant entrance. There will be the morning ritual will have a true coffee shop feel, anchoring the amenity on the right there, and then leasing entrance as well, which will be integrated with co-working. So very excited about what we're doing here at Dublin, and this will be, again, we'll be starting here towards the end of this year, and it'll really be the blueprint of what we try to accomplish at each of our amenities going forward. This, what you're looking at here, is the Germantown amenity. We're in the initial stages of the redesign here. With Germantown, I'll say our focus is, as you come in there, we're going to pull morning ritual to the corner. You can see the awning with the signage there. Again, giving it the true coffee shop feel. But that whole entrance into Germantown will look and feel like a true retail corridor, as opposed to, say, the entrance to an apartment community. We want your eye to be pulled in there to draw you in to see the code signage, to see the GOAT signage as you move in there. So a completely different feel. But again, our amenities are one of the greatest competitive advantages that we have. We want to showcase and highlight them. We want them to be the leasing and demand drivers to our community. And we want to really be a parent that's welcoming to all third parties. With that, Anna, I guess I'll turn it back over to you.
Thank you, Rob. Thanks for joining us this morning. Exciting progress in Gahanna with everything that's underway. Sounds like Dublin and Germantown on the horizon. And props to your team for all their work across the board on these projects. That wraps up our meeting for this month's town hall. We look forward to coming back together with all of you next month, July 12th. And you can plan to hear from NEP and Armada for their quarterly update. With that, we will send a link out to the recording if you happen to miss any part of this meeting. But otherwise, thank you all and have a great rest of your day.